Now we're going to move on and talk about non-recognition transactions. So we've talked before about realized versus recognized gains and losses. Realized gains and losses occur when the asset is disposed of and the adjusted basis does not equal the fair market value of property received. In this case, taxpayers realize gains and losses on the exchange of assets just as if they sold them for cash. Recognition occurs, so recognition, when you pay tax on the gain or deduct the loss. So remember, recognition is we're putting something on our tax return. It occurs when realization occurs generally, but we're going to talk now about situations where realization occurs, but recognition does not occur, when there's a deferral allowed by the Internal Revenue Code. So typically, realization and recognition both happen. We're talking now, though, about non-recognition transactions. So transactions where we've realized a gain or loss, but for whatever reason, we're not going to recognize that gain or the loss on the tax return. So 3 questions to consider when disposing of assets. First, do we have to recognize the gain or the loss? Meaning, are there tax consequences? 2, what is the character of the gain or the loss? So is it going to get preferential tax treatment? Is it going to get ordinary tax treatment? And then third, what is our basis in the new asset? Non-recognition transactions. So non-recognition transactions result in mandatory deferral. So mandatory deferral. If you qualify for a non-recognition transaction, you don't have a choice. So it's mandatory deferral of the gain or the loss. There are 3 types: like-kind exchanges, involuntary conversions, and installment sales. We are going to focus on like-kind exchanges. And a lot of tax planning happens in relation to these non-exchange transactions. So it's a big opportunity for tax planning to occur. All right, so with a like-kind exchange, which is the type of non-recognition transaction that we're focusing on in this class, a taxpayer is trading one similar asset for another. The transaction results in a mandatory deferral of the gain or the loss, and we're first going to try to understand why. The reason is twofold. First, there's a continuation of investment. There's really no measurable change in the taxpayer's position. So the taxpayer had an asset before, now they have a very similar asset. So there's not a real measurable change. And second is the wherewithal to pay. When you're exchanging an asset for another asset, you don't have the cash to pay the taxes necessarily. So the exchange may not involve transfer of cash. And transfer of cash is how we are going to pay. So we wouldn't have the wherewithal to pay. All right, to qualify for a like-kind exchange, we have to meet all 3 criteria. So we must meet all 3 criteria. First, there's a use requirement. Actually, I'm going to highlight all of this. I like to highlight. It's very important. Okay, so there's a use rule, the property both before and after the exchange. So the property must be used in a trade or business or held for the production of income. So we're going to say this is investment. Both before and after the exchange. This is applied on a taxpayer by taxpayer basis. So this is worth noting because if you have 2 taxpayers that are involved in an exchange, one taxpayer may get like-kind exchange treatment and the other taxpayer may not. So I'm just going to say one taxpayer may qualify for deferral, while the other taxpayer in the exchange doesn't. So we're looking at each taxpayer individually. Both taxpayers don't have to qualify for the exchange. All right, so Jason has used a loft for his business for the last 5 years. Angela has lived in a historic house for the last 10 years. Jason and Angela agree to exchange properties. Jason's planning to modify Angela's house to make it appropriate for use for his business, while Angela will modify Jason's loft to turn it into a personal residence. Does this qualify for a like-kind exchange for Jason? What about for Angela? So for Jason, the answer is yes. For Angela, because of how she's using the property, no. Angela doesn't use the property for business purposes. All right, there are rules about the type of property. So we've had, the first rule was about the use of the property before and after the exchange. Second is the type of property. The property must be exchanged solely for like-kind property. Now, you'll probably find these rules to be a little bit strange. We only have like-kind exchange treatment for real property. Personal property is not anymore. Under Tax Cuts and Jobs Act, personal property is no longer eligible for this treatment. Real property is always considered like-kind. So you can exchange a warehouse for a condo or land for something else. It doesn't have to really be this like-kind that you're probably thinking of. It used to be that when you could trade personal property, you had to have classes of assets that were similar. And so there was this idea that they had to be similar enough to receive this treatment. But under the new rules, the type of property, it must be real property, and real property is always going to be considered like-kind with other real property. All right, property that's ineligible for like-kind treatment are things like inventory and domestic property being exchanged for foreign property. So what I mean by inventory is if you have real property that is your inventory because you're a property dealer, you can't get like-kind exchange treatment. And if you're talking about exchanging domestic property for foreign property, that is where the line is drawn in terms of it not being considered like-kind. The third rule is the type of exchange. So the exchange must be direct. We do have exceptions to this. It is a property for property exchange. And there are exceptions. C kind of is the exception to A. If you're dealing with an intermediary, certain time requirements must be met. So let's first look at this picture. So this is from your textbook. So if I'm this taxpayer and I give this or I sell this third-party intermediary some real estate, and I could have another buyer over here and another seller over here. So there's several people involved. When you're thinking about real property, if I want to sell my condo at the Lake of the Ozarks and get some other property in exchange, what are the chances that I'm going to find somebody who wants a condo at the Lake of the Ozarks who I want to get what they have? You know, finding that match. And so we have these intermediaries that make it possible for people to find property that they're interested in and still get this like-kind exchange treatment. So if you're using an intermediary, the taxpayer must identify the like-kind replacement property within 45 days of transferring their property. So if I'm transferring my property to the third-party intermediary, within 45 days I have to have identified the property that I'm getting. I must have received the property, the new property that I'm getting, within 180 days of transferring my property. So while it says that the exchange must be direct, you can work with an intermediary that will help facilitate a transaction where everybody's happy and everybody's finding property that they're interested in. All right, the tax consequences of a like-kind exchange. First, we have two types of like-kind exchanges. The first one is going to be the tax-free exchange. The entire gain or loss is deferred. This is the simplest scenario. The entire gain or loss is deferred. Then we can have partially tax-free exchanges. So you may recognize some of the gain. So partial of the gain. And I want to just note here, never a loss. So losses are always deferred. So if you have a gain, it could be partially tax-free. If you have a loss, it's going to be deferred. All right. The tax-free like-kind exchanges, only like-kind property is included. So think about swapping two pieces of land. Nothing else is involved in the transaction. So no other trades, let's say. You don't recognize a gain or a loss on the exchange. The basis in the new property is equal to the adjusted basis of the old property. So we call that a carryover basis. 4, you continue to depreciate the new asset on the same schedule as the old asset. So however many years you were into depreciating your old asset, that's where you're going to just pick up and keep depreciating the new asset. The holding period equals the holding period of the old asset. So you get the longer holding period, and that's a benefit to the taxpayer. Then lastly, the character of the eventual gain or loss depends on the use of the property and depreciation. So eventually you're going to sell this second asset. You had your original asset, you exchanged it for a like-kind asset, and eventually you're going to sell it. And so we're saying the character of that eventual gain or loss will depend on how you used the property. All right, so MKT Inc. owns an office building worth $800,000. Adjusted basis is $400,000. So we have an office building, $800,000 is the fair market value. I try to label some things when I can in these problems to make it a little bit easier. And it was built on land worth $200,000. In November, MKT exchanges its property for another building worth $800,000 built on land worth $200,000. How much gain does MKT recognize? And what is MKT's basis in the new building? So this is what I was referring to a little bit ago. So MKT decides they want to get rid of their original building and they want to get another building, and they're lucky to find this person. So this is kind of unusual. All right, it's the simplest version of the problem, but a little bit unusual because what are the chances MKT is going to find another asset that is exactly what they want and the other people are going to want their asset too? So maybe not so realistic, but we'll keep rolling with it. So for MKT, the realized gain or loss, we have the $800,000. So that's what I'm getting. Fair market value of the new minus my adjusted basis of $400,000. So I'm using new and old, so adjusted basis of the old gives me a $400,000 gain. The recognized gain. So I realized a $400,000 gain, but the recognized gain is 0 because it's a tax-free exchange. These properties are like-kind, and I am able to defer the gain. Basis in the new building is the $400,000 carryover basis. So it's the same basis that I had in my building initially. So that $400,000 adjusted basis is my carryover basis that I'm using here. We really just consider this a non-event for tax purposes. Again, for two reasons. One is nothing really changed. I had a building, I have a different building, we're going to keep going with it. So there's that, did something of substance ever happen? Not really. And then second, the wherewithal to pay. I didn't get any money. I exchanged a building for a building. And so taxpayers are frequently in situations here where they don't have any means to pay the tax in this situation. All right, next we're going to talk about partially tax-free like-kind exchanges. So this occurs when two properties, so we have two people, they want to exchange something. So we have the two properties and they do not have the same value. So that seems pretty likely. For example, someone owns an asset worth $1 million, someone else owns an asset worth $800,000. They're not going to exchange those two assets unless something else is thrown into the mix. So what do parties do? The party with the asset worth less, so the party with the lower valued asset, has to compensate some way. So I'll just say some other way. And I mean, typically they're going to throw in cash, but we call this boot. Okay? So there's you and there's me. And you're giving me an asset worth $1 million. And I'm giving you an asset worth $800,000. You're not going to take that deal unless I give you something else. And we call that something else boot. The value of what we're exchanging has to be the same or people aren't going to engage in the transaction. Okay? So we have two types of boot. First, I want you to note we always value boot at fair market value. Boot is non-like-kind property that's included in the exchange. So it's included to make the transaction work. So if I don't give you boot, you're not going to give me your $1 million building for my $800,000 building. All right, type 1 boot is the assumption of a liability by the other party. So it's equivalent to giving that person the amount of the liability in cash. Okay? We'll talk about reducing type 1 boot in a little bit. We also have type 2 boot. So type 2 boot is cash and non-like-kind property received from the other party. So non-like-kind property is other tangible or intangible assets. We don't reduce this by anything. The government takes a balance sheet perspective, so it's different from what the book does, but this is correct. Okay? All right, number 4, we calculate what is the boot received in total. So type 1 boot plus type 2 boot. If the taxpayer receives boot, does the transaction qualify as a like-kind exchange? Yes, but you may have some gain recognition. So you're going to recognize gain. I'm going to put this in a red color since it's really important. Recognize gain equal to the lesser of the gain realized or boot received. So it's no longer a completely tax-free exchange. So I'll just say no longer a completely non-recognition event. You're going to recognize some gain. All right, again, as we saw before, the character of the gain or loss depends on the use of the property. And then the basis in the like-kind property received is the fair market value of what you got minus any deferred gain or plus any deferred loss. All right, so what is essentially happening here is if I have property that I'm getting, so let's keep going with our $1 million situation. $1 million is what I got, minus any deferred gain. If I reduce my basis by a gain that I'm deferring, let's just say it's $250,000, my basis will be $750. I will recognize that $250,000 gain when I sell this asset. You're adjusting the basis so that when you sell the asset, the gain or the loss is reflected at that time. So you're just kind of embedding in your new basis whatever impact, gain, or loss needs to happen in the future.